Welcome to Mr.M Talks. This channel is updating share market information day to day. Debt to equity ratio. The debt to equity (DA) ratio is a crucial financial metric used in the stock market to assess a company's financial leverage by comparing its total debt to its shareholders' equity. This ratio provides insights into the extent to which a company relies on debt financing relative to its equity. Definition and formula. The debt-to-equity ratio is calculated by dividing a company's total debt by its shareholders' equity. The formula for the debt-to-equity ratio is expressed as follows. Debt-to-equity ratio equals total debt, shareholders' equity, where total debt includes both short-term and long-term debt obligations. Shareholders' equity represents the residual interest in the company's assets after deducting its liabilities. Components of debt-to-equity ratio calculation. Total debt. Total debt encompasses all forms of debt on a company's balance sheet, including bank loans, bonds, and other financial liabilities. Shareholders' equity. Shareholders' equity is the residual interest in the company's assets after deducting its liabilities. It includes common stock, retained earnings, and additional paid-in capital. Example illustration. Suppose a company has total debt of $30 million and shareholders' equity of $50 million. The calculation of the debt-to-equity ratio would be as follows. Debt-to-equity ratio equals $30 million per $50 million equals 0.6. In this example, the debt-to-equity ratio is 0.6, indicating that the company has $0.60 in debt for every $1.00 in equity. Significance of debt-to-equity ratio. Financial leverage assessment. The debt-to-equity ratio provides insights into a company's financial leverage, indicating the proportion of debt relative to equity. A higher ratio suggests higher financial leverage and increased reliance on debt financing. Risk evaluation. Investors and analysts use the debt-to-equity ratio to assess the financial risk associated with a company. Higher debt levels may increase financial risk, as the company must meet interest and principal repayments. Industry comparison. Comparing a company's debt-to-equity ratio with industry averages helps investors understand its capital structure in the context of its peers. Investor confidence. A lower debt-to-equity ratio may be viewed positively by investors, indicating a lower reliance on debt and potentially lower financial risk. However, a moderate level of debt can be considered healthy for strategic growth. Considerations and limitations. Industry norms. Optimal debt levels vary by industry, and what may be considered normal in one industry might be high in another. Industry benchmarks should be considered when interpreting the debt-to-equity ratio. Business life cycle. Companies in different stages of their life cycle may have varying debt requirements. Younger companies may require more debt for expansion, while mature companies may aim for lower debt levels. Interest coverage. While the debt-to-equity ratio provides an overview of leverage, it's essential to also consider a company's ability to cover interest payments, reflected in metrics like the interest coverage ratio. Conclusion. The debt-to-equity ratio is a fundamental metric in financial analysis, providing valuable insights into a company's capital structure and financial leverage. Investors use this ratio to assess risk, compare companies within industries, and make informed decisions about the financial health of a company. However, it should be interpreted in conjunction with other financial metrics and industry benchmarks for a comprehensive understanding of a company's financial position and risk profile. Declaration. Below information is educational purpose only. Please subscribe and support my channel.